Today, what we are going through is to be the differences between CARO 16 and CARO 2020. I would like to welcome my other colleagues, Sarthak and Ankit, who are going to take you through the presentation. Basically, I would be taking the introduction part. Ankit would take you through the clauses of CARO 16, and Sarthak would take you finally through the clauses of CARO 2020 and explain you the differences between the two. Some basic rules for the webinar. We would request everyone to be on mute, and the question and answer session we will conduct after we complete our presentation. So now I would like to jump on the evolution of CARO. So basically, CARO stands for Companies Auditors Report. Reporting under CARO dates back to 1988 when the government introduced Manufacturing and Other Companies Auditors Report, MAO CARO. It was basically called MAO CARO 1988. MAO CARO was then succeeded to CARO 2003. Then it was succeeded by CARO 2015, subsequently CARO 16, and now currently CARO 2020. With every succession, the reporting has increased and so the responsibility of auditors. Currently, CARO 2020 is considered to be the largest in terms of reporting requirements among all the previous orders. The reporting under CARO, in MAO CARO, there were about 20 to 24 main clauses. CARO 2003 had about 21 main clauses. CARO 15 had about 12 main clauses. CARO 16 had 16 main clauses, and now CARO 2020 has about 21 main clauses. We do call it CARO 2020 because earlier it was applicable for financial year starting from 1st April 19. But now, because of the COVID situation, this has got extended, and now it is applicable only from for the financial year starting from 1st April 2020. So next year, when we give audit reports for March 21, CARO 2020 is going to be applicable. So why was CARO introduced when you already have an audit report in place? CARO was basically introduced to mandate the auditors to report on certain matters which are very relevant for enhanced reporting, increased transparency for stakeholders. So basically what happens is CARO is a statement. There are questions which have been asked and you need to answer on those questions. So it is basically a matter of fact that you need to reporting. Hence we call it to be an enhancing reporting. And after reading the CARO, you get increased transparency. You will be able to understand the company better. For example, there are some clauses on FA, there are some clauses on inventory. So you are able to understand deep down by reading a standard audit report. It is very difficult unless and until the auditors have qualified the report or they have drawn an emphasis. It is very difficult to understand what is actually happening in the company. So for increased transparency, CARO was introduced. The important aspects of CARO are Section 143(11) of the Companies Act 2013 requires the auditor's report of specified companies to include a statement on the prescribed matters which have been stated in CARO 16. So these matters are already defined and the institute comes out with CARO. So accordingly, you have to report and then the audit report is considered to be completed. The Auditing and Assurance Standard Boards of ICAI publishes various guidance notes on time-to-time basis so that it provides guidance to the members for fulfilling the requirement. Sometimes what happens is that since it is only a statement, it will be very difficult for you to understand what exactly needs to be reported. So in the guidance note, the guidance is properly given as to what needs to be reported, what you have to state over there. So all that has been stated in the guidance note. Now I would like to jump on the applicability of CARO. So first of all, there are no changes between CARO 16 and CARO 2020 in terms of applicability. CARO 2020 is applicable to all public limited companies, private limited companies, foreign companies, except those are specifically exempted. The exempted companies are banking companies, insurance companies, companies that are licensed to operate under Section 8 of the Act, one-person company, small company, and a private company. I would like you all to notice that it is on the fulfillment of all the below conditions. If any of the conditions don't satisfy, then CARO has to be applicable. Private company, which is not a subsidiary of public, which is not a subsidiary of holding or a public company, a company which has a paid up capital and reserves and surplus of not more than 1 crore, does not have a total borrowing exceeding 1 crore, and does not have total revenue from discontinuing operations more than 10 crore. Means if the revenue exceeds 10 crores or if the borrowing exceeds 1 crore, then still CARO is applicable. Any one of the conditions satisfied means CARO stands to be applicable. So it is very important nowadays. As we progress, most of the companies CARO gets applicable, because generally companies have a paid up capital of about 1 crore. The important points of the CARO, what we would like to specify are: it is not applicable for audit. It is also applicable for audit of branches. It is not applicable to the consolidated financial statement, except for one clause, which while we take the clauses of CARO 2020, we will specify. Reporting is required to only for those matters which are applicable to the company. In CARO, there is a specific point that you can state it is not applicable in the clause itself, but if there are 20 clauses, your report should have all the 20 clauses. You cannot skip any clause. The reporting is a supplement to the audit of financial statement. It is not considered to be a separate reporting engagement. Whether an auditor is able to express an opinion on a certain matter, if he is not able to express, for example, he needs to state the fact why he is not able to express. Auditor is required to give reasons why it is an adverse or a qualified opinion. Auditor has to consider if there are any favorable or if there are any adverse comments in the CARO, then auditor might consider it to bring out in the main financial report. For example, if the auditor finds out that there is a big problem with the fixed assets, then the auditor can accordingly decide that they have to report this in the main report as well. So CARO is very important, considering this, that CARO statement is as good as, you have to report it for the main also if there is an issue with it. Jumping on why CARO has been changed time and again, there are instances of frauds which we all know time and again. There are enhanced expectations of regulators, ICI, SEBI, NAFRA, SFIO, in the light of these scams. There is increased activism pressure on regulators to demonstrate actions to those guilty, and detailed reporting helps the regulators also. So as I said earlier, that it is for increased transparency to stakeholders, it also helps the transparency for the regulators. I would now like Ankit to start with CARO 16.
Good afternoon, all. So, firstly, I would like to thank Disha to explain us with respect to the applicability, with respect to the evolution, and also talking about the important aspects of CARO. So, like Disha earlier said, that before jumping to CARO 2020, I'll be first be taking you to CARO 2016 clauses, considering CARO 2016 would be nothing be the base for CARO 2020, like an extension to CARO 2020, because most of the clauses would be coming from CARO 2016. So, coming from to the first clause, which talks about fixed assets. Can you move the slide? So over here, there are three subclauses which the auditor needs to comment upon. The first subclause talks about whether the company has maintained proper books of records when it comes to fixed assets. That is, an auditor needs to verify the fixed asset register. He needs to check whether the qualitative as well as the quantitative impacts of the respect to fixed assets have been considered or not. Considering your depreciation working would be coming from your fixed assets, so an auditor needs to take into consideration the books of records as well as supporting documents are in place with the company or not. The second sub point talks about physical verification of fixed assets. Over here, the auditor needs to comment upon whether the company has physically verified the fixed assets during the current year or not. Over here, the physical verification can be phased over a period of 2 years or 3 years, depending upon the nature of the fixed assets and the size of the company. Also, an external consultancy firm may be also appointed by the company, as well as an auditor himself can also help the company in verifying the fixed assets. Also, in case if there are any excess or discrepancies observed by the auditor during the course of physical verification or via a physical verification report, on if in case it is done by the company or by the external consultancy firm, the same needs to be taken into consideration by the auditor, and the auditor must check whether the said impacts have been taken into consideration in the financial statements. The third subclause talks about immutable property. In cases if companies are holding any immutable properties as of the balance sheet date or during the current year, the auditor must check whether the title deeds are held in the name of the company or not. Moving ahead to the second subclause, which talks about the physical verification of fixed assets. which talks about inventory. As you may all know, inventory would this clause only be applicable only to companies who have actual inventory in place. That is mainly due to trading companies and your manufacturing companies. So it won't be applicable to service companies, as the case may be. Over here, an auditor needs to take into consideration whether the management or external consultancy or the auditor has done physical verification of inventory in the current year or not, at reasonable intervals or at the end of the year, as the case may be, depending upon the size of the company or depending upon the nature of the inventory held by the company during the year or at the end of the date. Also, in case of any discrepancies or any excess inventory is reported as of the balance sheet date or during physical counting, the said should be taken into consideration by the auditor and accounted in the books of accounts accordingly. The third subpoint deals with loans. In case if the companies are giving any loans to the related parties, the said should be done in the provisions of section 118 of the act. That is, all your secretarial compliances covering your contractual arrangements must be taken into consideration under while providing of loans. For example, if I'm giving a loan to a related party amount to rupees 10 lakh, the said should be the said necessary conditions such as approval by the board of directors, the proper minute should be minuted. Also, the necessary contractual arrangement must be taken into consideration of statutory register, and along with the necessary e-forms must be filed if required. Also, an auditor also needs to comment upon whether such loans given by the company are not prejudicial to the company's interest. Also, there should be a schedule for repayment. Along the auditor needs to take into consideration whether the receipts of the same respect to the loans given are regular in nature or not. In case if the same are not and the same are overdue for a period of more than 90 days, the said fact must be reported in the CARO report along with the necessary steps taken by the company for the recovery. Moving ahead to clause 4, which is an extension of the earlier clause, which talks about in case of any loans given by the company, in case of any investment made by the company, in case of any guarantees or any security provided by the company during the year or as of the balance sheet date, the said must be in compliance with section 185 or 186 of the act. Section 185 talks about in case of any loans or are given by the company relating to the directors of the company or other related parties. 186 talks about any loans given to then outsiders of the company other than your related parties. Okay. Moving ahead to clause 5, which talks about deposits. In case the company has accepted deposits during the current year, the company must take into consideration the said must be in line with the directive issued by the RBI and in line with the provisions of section 73 to 73(6) of the Companies Act, along with the relevant rules issued thereunder. In case if an auditor finds in case there are any non-compliance with respect to the deposit, the said fact must be reported in the CARO report. Moving ahead to the clause 6, which talks about in case if the company is required to maintain any cost audit records under the provisions of section 148 of the act, the auditor is required to check whether the said is in line with the applicable section or not. Moving ahead to clause 7, which talks about statutory dues. Over here, the guidance note has bifurcated the statutory dues into two subclauses, which mainly includes the undisputed statutory dues or the disputed statutory dues. Undisputed statutory dues, in case if there are no appeals taken by the company with respect to the statutory dues, are defined as undisputed statutory dues. In case if there are any disputes in which the company is fighting for, in case the company is fighting the same in the court or in any in under any law, the said is classified as a disputed due. So in case of undisputed due, what an auditor needs to do, he needs to check whether any delays are observed during the course of his audit. In case yes, the auditor needs to report the same in his CARO report. In case the delay are more than 6 months from the date of the balance sheet date. Also, in case of disputed dues, a similar stand is taken. However, the amount as well as the forum to which it is pending needs to be reported in the CARO report. So if we move ahead, there would be a sample. There's a sample of your reporting which needs to be done in your CARO report. For example, in case there was a delay observed by an auditor with respect to PF, so the name of the statute would be the name of the act, that is the Employee Provident Fund and Miscellaneous Provisions Act 1952. The nature of the due would be Provident Fund. The amount needs to be mentioned. The period needs to be mentioned along with the necessary due dates and the date of payment. In case if it is paid, it needs to be mentioned. In case it is unpaid, it would be unpaid. Similarly, with respect to profession tax, labor welfare fund, and other ESIC funds or any other statutory dues, the same needs to be mentioned in a similar format. The only difference between your undisputed statutory due and the disputed statutory due would be an additional column in form of the forum to which it is pending would be mentioned in this table. Okay. So moving ahead to clause 8, which talks about in case if the company has taken any loans from any financial institution, banks, government, or there are any dues to debenture holders, in case if an auditor finds any defaults with respect to repayments of the same, the said should be reported in the CARO report by the auditor. Also, the period of the default along with the amount lender wise needs to be mentioned by the auditor. Coming ahead to clause 9, it talks about in case if the company has raised any money via an IPO, the auditor needs to check whether the said money so raised through an IPO is utilized for the purpose for which it was raised. In case if there are non-compliance observed by the auditor, the said fact needs to be mentioned in the CARO report. Coming ahead to clause 9, which talks about in case if there are frauds observed by the company or on the company by an auditor with respect to his officers and employees during the year or as of the balance sheet date or before the date of signing the financial statements, the auditor the said fact needs to mention in his CARO report along with the nature of the fraud so done along with the amount so involved. Moving ahead to clause 11, which talks about material remuneration. This clause is only applicable to limited entities and it is not applicable to private entities. In case an auditor needs to check a material remuneration is paid by the company to a director or a person so involved managing the company, the said remuneration needs to be paid under the provision of section 197 of the Act and Schedule 5 as of the Act. In cases if the amount so paid is was more by the company must be taking relevant steps with respect to recovery of the same, and accordingly the said fact needs to be reported by the auditor. Moving ahead to clause 12, which talks about in case a company is an ED company, the company must be taken into consideration of the fact that the NIDI rule 2014 are complied by the company. That is compliance of the net owned funds to deposit in the ratio 1:20 to meet the liabilities and maintenance of 10% of the unencumbered term deposits as to meet the liabilities as the case may be. Clause 13 talks about related party transactions. So under over here, in case if the companies has entered into any related party transaction during the current year, the same must be under the compliance of section 177 and 188 of the Act. That is all your CS compliances needs to be taken into consideration. That is proper approval by the board. The proper e-form needs to be filed along with the proper register needs to be maintained. Also the said fact also needs to be checked via AS 18 disclosure, which would be there in the financial statements. Moving ahead to clause 14, which talks about in case if there are any preferential allotment or private placement made by the company during the current year when it comes to your partly or fully paid shares or debentures in the current year, the said should be in compliance with section 42 of the Act. In case if the amount raised via preferential allotment or private placement is not utilized for the intended purposes for which it was raised, the said fact needs to be reported by the auditor in the CARO report along with the nature and the amount so involved. So moving ahead to clause 15, which talks about in case if the company has entered into any non-cash transaction during the current year with the directors of the company or the person so involved with the company, then the company must be complying with the section 192 of the Companies Act. Under section 192 of the Companies Act, the company must take into consideration, like I said earlier also, whatever the company is doing, the same should be documented by the company in form of minutes, your other documentary evidences by filing proper e-forms. Over here, the additional requirement would be getting your non-cash transaction valued by a registered valuer. Moving ahead to the last clause, it talks about in case if the company is required to register under provision section 45A of the Act, that is your NBFCs, the auditor must take into consideration whether the same has been done by the company or not. Okay, I think so. This does with CARO 2016. So for CARO, to explain the differences between CARO 2016 and CARO 2020, I'll hand over the same to Sarthak.
Good afternoon, everyone. Thank you, Ankit sir, for explaining the clauses of CARO 2016. Now I will continue with explanation of CARO 2020. Out of the 16 clauses in CARO 2016, 15 of those clauses have been continued. Only one clause has been dropped, which we will discuss at the end of slide. Those 15 clauses have either been taken as it is, or there have been certain changes been made in those clauses. Some clauses only have minute changes to bring them in line with the current words being used in the laws and standards, and certain clauses scope has been enhanced to give more safety to the stakeholders. Clause number 1, property, plant and equipment and intangible assets. First point, separate reporting is required for records of property, plant and equipment and intangible assets instead of collective reporting as fixed assets. Earlier, intangible assets was not required and PPE was called as fixed assets because in the old system of accounting standards, we had AS10 fixed assets and AS6 depreciation. Now AS10 and AS6 have been merged to form AS10, the revised AS10, that is property, plant and equipment. Also in Ind AS, we don't call fixed assets as fixed assets. We call them property, plant and equipment. So the terminology has been updated to bring them in line with the accounting standards. Point number two, introduce exemption from reporting in case of title deeds. Under CARO 2016, reporting was required in any manner, irrespective of whether it was a lease agreement or not. All the title deeds were required to be reported. Now it is the first time that an exemption has been introduced in cases where there are lease agreements with only companies and the company has to be a lessee. Specific details are to be reported in case title deeds are not in name of the company. So if title deeds are not in name of the company, the auditor is required to report the description of the property, its gross value, name of the person in whose name the title deed is made instead of the company, the reason for such different name, and if any disputes are going on between the company and such person, then the same also needs to be reported. Uh, Title deeds are for movable property. Only those immovable property which are shown as property, plant, and equipment or as non-current asset held for sale in the financials of the company will be covered. If a company is showing immovable property as its inventory, for example, a real estate company shows immovable properties as inventory, then this reporting of title deeds clause will not be applicable to such companies. Point number four, introduced specific reporting requirements on revaluation of property, plant, and equipment, including right of use assets. So, under this clause, the auditor is required to report whether any revaluation has been taken place. Next thing is required to report whether that revaluation has been carried out by a registered valuer. And the last thing he needs to report is if for any class of assets revaluation has been conducted and the amount of change is more than or equal to 10%, then the auditor is also required to report the change amount. Point number five, under property plant equipment, disclosure of proceedings under the Benami Transaction Prohibition Act 1988. So, under this sub clause, only those transactions are covered which are subject to a Benami transaction point. Benami transaction is a transaction which involves a Benami property. So, how to understand this sub clause, we need to understand what is a Benami transaction. So, Benami transaction is a transaction where the asset has been transferred by one person and the consideration is paid by another person, or a situation where the immovable property is held in the name of a fictitious entity, or the owner of the property is not traceable, or where the registered owner of the property denies the ownership of the property. In such cases, the dispute going under the act falls under a Benami transaction. What is to be noted is only existing proceedings are to be reported. So if an auditor has a hunch that a property should fall under a Benami transaction, but there are no legal proceedings going on again around that property, then it will not have to be reported. Only the ongoing proceedings need to be reported. Uh, Clause number two, inventory and current assets. Point number one, introduce requirement to comment on appropriateness of management's physical verification process and a threshold limit of 10% for reporting on discrepancies of inventory. So the auditor is required to evaluate whether the physical verification process of the management is commensurate in accordance with the size and nature of the entity. If it is a small entity, simple procedures are enough. But if it is a big entity having diverse nature of inventories, a conglomerate which deals in a lot of goods, so the auditor has to evaluate whether the process is adequate to ensure a true and fair reporting in the financial statement. There's a threshold limit of 10%. So on the physical verification, if there's a discrepancy of 10% between the physical verified goods and the goods in the books of accounts, the auditor is required to report it and is also required to check whether how it is dealt with. Auditor is required to ensure that the satisfactory treatment has been given in the books of account to such differences. Next point, introduce requirement to verify quarterly statements filed with banks or financial institutions in cases where working capital limits sanctioned from such entities in excess of INR 5 crores against security on current assets of the company. So this is a very new requirement because so far up to CARO 2016, auditor was only required to verify items which are related directly to the financial statements. Verifying quarterly statements which are submitted to the bank is not directly related to the financial statements. So this is the first time a requirement has been introduced that the auditor is required to take additional responsibility for documents which do not form in any manner part of the financial statements. To understand this point, we'll have to break it into 5 parts. First part is introduced requirement to verify quarterly statements. So only quarterly statements are covered in this reporting. If a company has taken a loan and they are required to report to the banks or financial institution on a monthly basis, so there will be 12 statements which will be filed by the company. So even then, the auditor is not required to verify all those 12 statements. Only the statement for all the 4 quarters, that is June, December, September, and March. Only those 4 statements will be required to be verified. The loan should be availed from a bank or financial institution. So if a loan has been availed from a proprietorship entity, private company, partnership firm, such loans are not loans taken from such entities are not required to be reported here. In next part is in cases where working capital limits sanctioned. So only working capital loans. If a loan is not in the nature of working capital loan, then that will not be covered, and only the sanction amount is to be considered. So if the sanction amount is 4.5 crores and due to excess overdrawn balance or accumulated interest, the amount exceeds 5 crores at the balance sheet date, then it will not get covered because the stress is on the word sanctioned and not on the amount disbursed. The amount has to be in excess of 5 crores and it has to be again security on current assets of the company. So if the loan has been secured on any immovable property or any other non-current asset, then those loans will not be covered. So all these 5 conditions need to be satisfied for an auditor to be required to be reported under this clause. Subclause number 3, loan, investments, guarantees, securities, and advances in the nature of loan. Reporting coverage has been extended as follows: covers all parties instead of just those covered under Section 189. In CARO 2016, the reporting was only required for rated parties, which is rated parties are those parties which are defined by Section 189. Now the reporting is required for all the parties. So if any loan, investment, guarantee, or security is given to any person, even a non-rated party, that will be covered here. Coverage has been extended to investment made, guarantee given, advances in the nature of loans during the year. In CARO 2016, only loans were covered. Now investment guarantees and advances have been added. And what we need to note is it is only for those transactions which have been incurred during the year. So auditor is not required to report on the opening balances of these items. Only those transactions which have been initiated during the year are to be covered. Reporting on the adequacy of terms and conditions. The auditor is required to ensure that the terms and conditions are in no manner prejudicial to the interest of the stakeholders, be it may the shareholders or any other third party investors. Next point, additional reporting on loans renewed or extended or on grant of fresh loans to settle outstanding dues. So it may happen that the company may not be able to repay its loan on time. So it may go for renewal or extension, or it may ask the another bank for a new loan so that it can settle an outstanding due. In such cases, the auditor is required to report the amount of loan and the nature of such loan. Next point, additional reporting on loans repayable on demand or without specific terms. In such cases, the auditor is required to report the amount of loans, the percentage of such loans as compared to the total loans given by the company, and is also required to report if any such loans are given to the promoters or rated parties of the company. Clause number 4, compliance of section 185 and 186. There is no change in this clause. Clause 5, deposits. Only the text of the clause has been updated to remove any ambiguity. Now, clause specifically requires reporting for compliances in respect of amount deemed to be deposits as well. Clause number 6, cost records, no change. Clause number 7, statutory dues. To include reporting for GST under indisputed dues. Earlier in CARO 2016, the CARO did not use a bucket word like statutory dues. It mentioned individual indirect taxes specifically, which were covered in this clause number 7. Even though the reporting under GST was required as a part of this statutory dues, now only the text has been updated to bring it in line with the existing indirect tax laws. Clause number 8, unrecorded income. Reporting whether any previously unrecorded income, which was disclosed as income in tax assessment in previous year, has been recorded properly or not. So it may happen that when the books of accounts are being closed, a particular income may not be taken into consideration in the books of accounts when the financials are signed. Normally, income tax returns are filed after the financials are signed. So whenever the income tax return is filed, the company may add some more income in the income tax return. It may surrender, it may disclose it on its own, or there may be a assessment by the assessing officers, and they may come up with new additions to income. So in such cases where the income has only been recorded, only been considered in the income tax return and has not been taken into account while closing the financial statements, the subsequent year, the auditor needs to ensure that such extra income has been taken into account in the next financial year. The auditor will also need to consider the impact of AS5 with respect to prior period items, because if such item is prior period income, then he needs to make a specific disclosure in the financial statements. Clause number 9, repayment and usage of borrowings. This was clause 8 in CARO 2016. Only repayment of principal amount was covered before. Now interest has also been brought under the coverage of this clause. This does not mean that the auditor was not responsible to audit the interest portion. He was responsible to audit the interest portion. It was just that under CARO, reporting was not required for interest. Reporting was required only for the principal amount. Now in CARO 2020, both are covered. Next point, details required to be reported in case of defaults have been increased. Earlier, only limited details were required to be reported. Now, the auditor is required to specifically mention the nature of borrowing, the name of the lender, the due date, whether the amount is principal or interest, the number of days for which it has remained unpaid, and also any specific remarks that the auditor wants to give. Next point, coverage of the clause has been extended to all the lenders. In CARO 2016, only 4 types of lenders were covered. That is banks, government institutions, financial institutions, and debenture holders. Any other parties other than these 4 were not covered. So now the extension has been made to all type of lenders. So now even if a loan is taken from a proprietorship, private company, partnership firm, or any other corporate entity or non-corporate entity, those reporting will be covered here. Next point, additional reporting requirements for short-term and long-term borrowings, funds borrowed for assisting group entities or by pledging securities of group entities. So this point covers 4 types of loans. First is short-term loan. If a short-term loan is utilized for a long-term purpose, then the nature of such misutilization and the amount of misutilization has to be reported. Long-term borrowings. Under long-term borrowings, if the loan has been borrowed for a particular purpose, which has been agreed with the lender, and the funds are actually utilized for some other purpose, then such misutilization has to be reported along with the amount. Next point, funds borrowed for assisting group entities. If a company has borrowed any funds for providing financial assistance or settling obligations of a group entities like its subsidiary, associate, or joint venture, then the name of such entity, nature of relationship, and the amount such borrowed for helping such group entities has to be reported. And lastly, pledging securities of such group entities. If the holding company has securities of a subsidiary company and to avail any fresh loan, it has pledged the securities of such subsidiary company, then the same nature of security, name of company, and the amount of loan has to be reported. Last point, report where company is declared a willful defaulter by any lender. So to understand this, we need to understand who is a willful defaulter. RBI circular by RBI has given the definition of willful defaulter. If a person has not paid payment or has not paid his principal amount or not repaid interest on a regular basis, and he has the capacity to pay those amounts, then he is declared a willful defaulter. Even if he has not repaid the amounts and has diverted the funds borrowed, then he will be a willful defaulter. And if he has disposed of or removed the immovable or immovable property on which security had been created without the knowledge of the lender, then he will be declared a willful defaulter. So wherever a borrower is declared as a willful defaulter, reporting will be required. Clause number 10, money raised through issue of shares. This was clause 9 and 14 have been merged to form clause 10. Earlier only compliance with section 62 was covered, 42 was covered. Now 62, that is right issue of shares, that is issue of shares to existing shareholders, has also been covered under the ambit of this clause. Clause 11, fraud. This was clause 10 in CARO 2016. Reporting of all frauds on the company is required. Earlier, reporting was required only for frauds by employees or officers. So, if an employee or officer of the company had committed a fraud against the company, only that was covered in CARO 2016. Now, even if any third party, like a debtor or creditor, has done any fraud against the company, even that will be required to be reported in CARO 2020. Disclosure of any report made to central government under section 143(12) of the Companies Act 2013. So this is a very wide section, and a lot of guidance was required on when this section was introduced. For this, ICI has published a separate guidance note to guide the chartered accountant members on how they should proceed with their frauds and how they should evaluate the matters on case-to-case basis. Reporting is required by the statutory auditor, but under Companies Act, the duties of a cost auditor and the duties of a secretary auditor are same as that of a statutory auditor. So even if a cost auditor or secretary auditor come across a fraud which is required to be reported under section 143, even they are responsible to make this disclosure. However, a tax auditor or a VAT auditor will not be required to make any reporting under this clause. So as per section 143.12, if the amount involved in fraud is less than 1 crore, then the reporting is directly to be made to the board of directors or the audit committee, whichever is applicable. However, if the fraud amount involved, estimated amount involved, is more than or equal to 1 crore, then the auditor has to take the comments of board of directors and audit committee and then make a report to the central government on this matter. Consideration of whistleblower complaints. The auditor, the company is required to set up a whistleblower mechanism. Only listed companies, companies which are accepted public deposits, and companies which have borrowed in excess of 50 crores from public banks or financial institutions are required to set up whistleblower mechanism. For rest of the entities, there is no mandatory requirement. So auditor on case-to-case basis can determine how complaints of the employees are being handled by the company, and he can provide his comments on the same. Clause 12, needy company. Additional reporting is required for defaults in repayment of deposit and interest thereon by a needy company. Clause 13 RPT, there are no changes in this clause. Clause 14 internal audit, reporting on appropriateness of the internal audit system and whether the internal auditor's report has relied upon by the statutory auditor. So auditor has to evaluate the effectiveness of the internal audit system. Internal audit system includes both the internal control set up by the management and also the function of the internal auditor. The auditor can check the past performance, source data used, experience of the internal auditor. He also has to take into consideration the nature and size of the company while evaluating both the activities of the internal control of the management and also the activities of the internal auditor. The auditor is required to report whether he has relied on the activities of the internal auditor or not. Clause 15, non-cash transaction with directors. There are no changes in this clause. Clause 16, registration under section 45I of the RBI Act. Additional reporting is required where a company carries out any non-banking financial or housing finance activity without a valid certificate of registration. So if any activities are carried out which are fall under the purview of RBI's requirement to obtain a certificate of registration, and those activities of financial nature have been carried out without obtaining such registration, then the auditor will require to report on the same. If there are some exemption criteria, if the company falls under those exemption criteria and the certificate is not required, the auditor is also required to evaluate whether they continue to satisfy those exemption criteria. Reporting in case of core investment companies, this is a new reporting requirement. Core investment companies are entities which invest 90% of its amount in shares and securities of group entities. Clause number 17, cash losses. New clause which requires auditor to report any cash losses in the company during the current as well as in the previous year. This is the only clause which also requires the auditor report on the status of the previous year. So how do we calculate cash losses? Our starting point will be net profit after tax. To net profit after tax, we will add all the non-cash items like depreciation, amortization, fair value changes, unrealized foreign exchange gain losses, deferred tax, and other non-cash items. Clause number 18, auditor's resignation. New clause for reporting resignation of statutory auditor, if any, during the year, and whether consideration is given to any issues, objections, or concerns raised by the outgoing auditor. So whenever an auditor resigns from his audit service, he is required to file ADT3. The incoming auditor, that is the new auditor, will have to send him a no objection request for no objection certificate, and the resigning auditor will issue him a no objection certificate that the resigning auditor has no objection with the incoming auditor accepting the audit assignment. While exchanging these letters with respect to no objection, the incoming auditor needs to inquire the outgoing auditor's reasons for leaving the audit. He also needs to check the same with the management. It may happen that the auditor has resigned due to some issues which had not been mentioned in his resignation letter. So the incoming auditor can also obtain a written representation from the management that the reasons stated by the outgoing auditor in his resignation letter are true and that there are no other reasons other than those mentioned in his resignation letter. If any objections are raised by the outgoing auditor, then the incoming auditor has to consider it after considering the materiality of the entity. And on the basis of this consideration, the incoming auditor has to decide whether to accept the assignment or not. Next clause number 19, financial position. Auditors to provide their opinion on whether no material uncertainty exists with respect to company's ability to meet its existing liabilities as at the balance sheet date, as and when they fall due within the next 1 year. While providing their opinion, the auditor needs to consider the financial ratios, aging, expected date of realizations of assets and liabilities, other information accompanying the financials, knowledge of about board of directors, and management's plan. So far, under Companies Act, under SEBI, or any other act which is applicable to the companies, there has been no requirement where the auditor is required to evaluate the liquidity of the entity, liquidity capacity of the entity. That is, whether they are able to discharge their liabilities properly or not. This is the first time that the CARO requirement has introduced a responsibility on the auditor to evaluate the ability of the entity with respect to its liability, which will fall within the next 1 year. To identify those liabilities, they have specifically mentioned the items given in the second para, that is the financial ratios, aging, and expected of realizations. All this kind of information will give a auditor a better idea on what are the expected receivables of the company in the next financial year, and also what are the expected payables of the company. This will give an auditor an idea on his final opinion on whether the company is liquid enough to discharge its liability. This is a very nice clause because the stakeholder will get a good idea on whether the auditor is confident on the liquidity position of the entity or not. Clause number 20, CSR compliance. New clause which requires auditor to verify compliance with section 135.5 and 135.6 of the Act in respect of unspent CSR funds. Section 135.6 deals with ongoing projects and section 135.5 deals with other than ongoing projects. In case the auditor has not deposited the amounts in 6 months from the end of the financial year, only the unspent amounts are required to be deposited. If any unspent amount is not deposited within 6 months, then it has to be deposited in any entity which is mentioned in Schedule 7 of the Companies Act 2013. These entities include social purpose entities, like those entities of the government which promote social causes like promoting education, women empowerment, eradication of poverty, hunger, malnutrition. Even PM Cares Fund is a part of the entities which are whose name are given in the Schedule 7. Under Section 135, the company is required to set up a CSR committee. A CSR committee is mandatory only for those entities whose net worth is more than or equal to 500 crores, whose net profit whose net profit is more than or equal to 5 crores, or whose turnover is more than or equal to 1000 crores during the immediately preceding financial year. Once a CSR committee is formed, it is responsible for formulating the CSR guidelines and utilizing and monitoring the utilization of CSR funds. The minimum amount of CSR amount which needs to be spent by the company is calculated by taking into consideration 2% of the average net profits of the company during the immediately 3 preceding financial years. There are a lot of queries which are raised by the CA members with respect to this. So again, to resolve all the queries and provide them guidance, ICI had published a guidance note on accounting for expense on CSR activities. The guidance note provides a lot of detail on how these sections are to be dealt with and complied with. Last clause number 21, reporting on the consolidated financial statements. This is a new clause which requires the auditor of holding company to report any qualification or any adverse remarks only under CARO, not under the main audit report, only under CARO by auditors of consolidated companies in their respective audit reports. This is the only clause which is applicable to consolidated financial statements. Clause number 1 to 20 are applicable to standalone financial statements. Clause number 21 is applicable to consolidated financial statements. Up to CARO 2016, there was no reporting required for consolidated financial statements. This is the first time that a reporting is required for consolidated financial statements. So, if the auditor of if there are 5 companies, there is a holding company and there are 4 subsidiary companies. The auditors of the subsidiary companies will be called as the component auditors. If the component auditors have made any adverse remark in their respective CARO reports, then the auditor is required to give reference to those adverse remarks in his. Then the auditor of the holding company is required to give reference to those adverse remarks in his CARO report of the consolidated financial statements. He is required to mention the name of the company, the corporate identification number of the company, relation of the company with the holding company, and the clause number under which adverse remark has been given. It is a point worthy of being noted is that the report which will be given in consolidated financial statements will also cover any adverse remark given in the standalone financial statements of the same company. And last part, note, reporting in respect of clause 11 of CARO 16, that is managerial remuneration, has been removed, as reporting of the same was already covered as part of the main audit report addressed to the shareholders of the company. The main audit report required the auditor to report on whether the managerial remuneration was computed correctly or not. So in order to remove redundancy and repetition, this clause 11 has been removed, and all the rest of the clauses, as we saw, have either been updated or taken as it is from CARO 2016. Conclusion: the dynamic changes in the existing clauses and the introduction of new clauses requiring reporting on certain paramount domains of a company financials and operations clearly indicate the increased expectation of the order from the auditors. The auditor has to take a lot more responsibilities in CARO 2020 than he was required in CARO 2016. More emphasis has been added on utilization of funds, financial stability of the company, regulatory compliances, and company's ability to discharge its liability. A separate clause has been introduced only for the purpose of reporting on company's ability to discharge liability. That shows that how relevant it has become considering the number of companies going into insolvency and bankruptcy. Certain existing clauses have been updated to protect interest of all stakeholders as compared to only certain category of stakeholders. As we saw, instead of covering just related parties, governments and banks, now all parties are covered whenever loans are given or whenever loans are taken. The order requires the auditors to be more conscious, skeptical, and accurate while discharging their duties. CARO has progressed to a certain extent along with international standards. The guidance note given by the Institute of Chartered Accountants of India is just not an exhaustive document. It is just, as the name suggests, it's just a guidance note. So the auditor is required to exercise his own professional judgment and experience on various matters which are required to be reported under CARO. Just because the clauses are given under CARO, auditor's responsibility is not limited to those 21 clauses under CARO. Auditor is still responsible for the entire set of financial statements, even though CARO is just an extra reporting so that only the key points which are relevant to the interest of the stakeholders can be brought to their attention easily.
Thank you, Sarthak. Thank you, Ankit, for taking us through CARO 16 and CARO 2020 clauses. I hope we've been able to cover the whole document properly. I would like to take up some questions. Any questions from anyone on these CARO clauses? Okay, thank you so much. Then we would close this webinar. Thanks a lot for attending.